Three software stocks, one to watch, one to buy, and one to ditch. Hello fellow investors. Last time I did low PE stocks don't always mean cheap with SWBI. This time I'm doing high PE stocks don't always mean expensive with three software stocks, CRM, ADSK, and CRWD. I want to do a much more detailed video about this because we have to break this notion regarding PEs. So if you could just hit that subscribe button so we'll reach more people in the stock market community and help them realize they need not to scare away from these high PE stocks. First stock to make my case is CRM. Just by looking at this, I know a lot of people would just walk away straight up seeing this high PE stock. They wouldn't even dare touch this, wouldn't even dare know why it's trading as such PEs. Anyway, this is CRM stock valuation summary. Believe me, I tried writing and dumbing down everything that's written here and what they represent, but I'd rather make a separate video explaining all this because, to be honest, there's a lot of info to take in. Anyway, it just means that the stock is trading at 27 times their margins, but it is now trading cheap based on historical price of free cash flow and PB ratio. This high PE here of 500 skewed my valuation metric. That's why it is important to know why that is. If we look back at their financials, the discrepancy between the profit margin and the free cash flow margin is by a lot. Now, I'm not an accountant, but I like to think this has to do with some accounting rules regarding the software business, and that skews the whole PE metric for all these software stocks. And that's why you see them with very high PEs. And that's also why we can use the EPS or PEs to value these kinds of stocks. The stock is now down 60% of the highs, EPS growth is down, diluted to 161 million shares in 5 years. They have decent margins, 18 to 20%. This is basically the backbone of my process. I pay 1 PE or less for 1% of their margins. I use the lowest band of their margins as my fair value multiple. Take note of that 18. We'll use that as our multiple for CRM stock. Let's look more into this stock. This is CRM stock charts along with the fundamentals and the price investors paid for in terms of PE, price of free cash flow, and PBs from the highs and the lows of the quarter. The black lines you see here are my fair values for each quarter. I got this by using the 18 multiple and multiplying that by the free cash flow per share 12 months. Normally, I'd use the EPS, but it's no help for these kinds of stocks because of the accounting rules like we discussed previously. My fair value for the stock has been hovering at around $100 for 5 quarters now. So basically, the sell-off was just a simple multiple compression. Because if you look at the revenues, it's still growing. The free cash flow, however, decreased for 2 quarters now, but not by a lot. Equity is also growing. I don't recommend buy at fair values. I don't buy stocks at a premium. I only recommend you buy below these fair values. And that's where I only recommend you do the DCA on this stock. Analyst forecast is still increasing sales and profitability. If the stock were to trade back to its value price, I'd be interested around $100. This is why I think you should put CRM on your watch lists. See if we get there by the next market downturn. Next stock is ADSK. Again, it's the same with CRM, high PE, only because of the accounting rules. They have decent margins, 24 to 32%. Nice EPS growth, 2 million shares bought back in 5 years. Not a lot, but sure, let's just look at their charts. Valuation summary is skewed by the PE anyway. As you can see, ADSK is now trading below my fair values. The multiple I'm using here is 24, but it is debatable just looking at their financials. You can use a lower multiple like 20. You can use a higher multiple like 32. It depends on you, your risk and return requirements. But again, to get fair values, you have to multiply this by the free cash flow per share trailing 12 months. My fair value for the quarter is around $200. Now, I'm not buying ADSK just yet, only because I'm waiting for the next market downturn. Maybe I'll get a much cheaper price than it is trading now. But if you're okay buying ADSK here, I'd understand. Just DCA. Also, I'm opening myself to the idea that maybe it should trade at 20 multiple. The cheaper the better. Analysts forecast still with growing sales and profitability. The estimates are to the upside. The stock falling is just multiple compression because the fundamentals remain strong. Revenue is still increasing. Free cash flow is still increasing. However, their equity is decreasing. But most tech stocks don't trade on PB anyway, so I think it's fine. This is why I think you should put ADSK on your buy list. I'll be waiting for the next market downturn if I were you to maximize profits. Next and last stock is CRWD. Obviously, this is the ditch one, as it's still trading at very high multiple from their fair values. The reason of the stock falling is multiple compression. The multiples it was trading at back in 2021 was just simply too rich for the stock, trading at 120 price to free cash flow. Now, it's only 40s. This is the same with CRM and ADSK. They're all growth stocks, although this stock has the higher rate of growth. Fundamentally, they're doing great. Revenue is growing fine. Free cash flow is increasing. Equity is increasing. This is their valuation summary. The reason why I ditched this is only because they're not profitable net income wise. Also, I only have 5 years of financial data of this stock. I think this stock is still in the early stages, but it sure shows some promising growth. My fair value for the quarter is $66. With this, I'm using a multiple of 26. Again, you can use a lower multiple like 20 to 24 like ADSK or a higher multiple like 28 to 32. It depends on you, your risk and reward requirements. Also, it's debatable. Like ADSK, their margins are not as clear as CRM. But again, the lower the multiple, the better, the cheaper. Analysts forecast with growing sales and profitability. The estimates are to the upside. That's my take on these three software stocks. CRM to watch, $100. ADSK to buy, $200. And CRWD to ditch at $66. Again, this fair values is only good for the quarter. I only react to their financials. These prices can go higher. These prices can also go lower. These stocks only have high PEs because of some accounting rules. Don't look into their PEs and EPS. Instead, look into their price to free cash flow and free cash flow per share. High PE doesn't always mean expensive, and I think we've proved it with these three software stocks. If you learned a thing or two in this video, consider subscribing to our channel. Also, visit our Patreon for more exclusive contents. See you next video.